Guten Tag and welcome back to the Global Business Channel. Thank you for joining me today. This video will discuss financial institutions in the context of the Financial Action Task Force's recommendations on anti-money laundering and countering the financing of terrorism and proliferation financing, which is necessary to understand to fully conceptualize the upcoming video on Recommendation 1 issued by the FATF on assessing risks and applying a risk-based approach regarding AML and CFT policies and coordination. First, we will define what financial institutions are, generally defined as. Second, we will see how the FATF defines financial institutions on page 129 of the FATF Recommendation Handbook. Last but not least, we will analyze how each jurisdiction has different legislative classifications for financial institutions, whereby banks, although falling into the definition of financial institutions under the FATF mandate, might be regarded as reporting persons or institutions and as non-financial institutions, but rather as banks. We will see how this applies to my home country, Mauritius. I hope you find this video informative, and as always, I wish you an enjoyable and insightful viewing. So, what are financial institutions? A financial institution, often referred to as an FI, is a company that conducts financial and monetary transactions, such as accepting deposits, providing loans, managing investments, and facilitating currency exchange. Financial institutions encompass a wide range of businesses within the financial services sector, including banks, insurance companies, brokerage firms, and investment dealers, to name a few. In developed economies, almost everyone has a need for the services offered by financial institutions on a regular or occasional basis. These institutions typically match funds from savers or investors with those seeking financing, such as borrowers or businesses looking to raise capital. This process often results in future payments from borrowers or businesses to savers or investors. Financial institutions use various tools and platforms, such as loans and stock exchanges, to facilitate these transactions. Fundamentally, financial institutions enable people to access the funds they require. For instance, banks, while providing a range of services, primarily collect funds known as deposits from individuals and businesses, pool these funds, and then lend them to others in need of financing. Banks act as intermediaries between depositors who lend money to the bank and borrowers who receive loans from the bank. Financial institutions offer a variety of products and services tailored to individual and commercial clients. The specific services provided vary widely among different types of financial institutions. Some common types that consumers frequently use include commercial banks, investment banks, custodian banks, credit unions, savings and loans companies, investment companies, financial advisors, investment brokers, investment dealers, investment traders, mortgage companies, and insurance companies. Those are just to name a few popular ones. What about cryptocurrency exchanges? Are they classified as financial institutions? It's ambiguous and it's complex. Despite the presence of numerous cryptocurrency investors and blockchain companies worldwide, most jurisdictions have not yet established a clear regulatory framework for this asset class. The Securities and Exchange Commission in the United States typically categorizes cryptocurrency as a security, whereas the Commodity Futures Trading Commission considers Bitcoin a commodity, and the Treasury Department identifies it as a currency. In the United States, crypto exchanges are subject to the regulatory provisions of the Bank Secrecy Act and must register with the Financial Crimes Enforcement Network, also known as FinCEN. They are also obligated to adhere to anti-money laundering and countering the financing of terrorism requirements. But then again, this depends on various jurisdictions regarding the regulatory framework. As far as I can tell, and I have watched numerous documentaries on this, I will go ahead and say it on record. 99.99% of crypto exchanges, coins, and NFTs are scams, rug pulls, and outright fraud. My advice to you, stay away from that caca. This is the only time I will curse on this channel. If you are enjoying the content of this video so far, I'd really appreciate it if you could post a like on the video and perhaps even subscribe to the channel, as this would help my growth with the YouTube algorithm and analytics to reach a wider audience. Lastly, if you would be interested in being a sponsor of the next video for 30 to 60 seconds, feel free to email me at theglobalbusinesschannel@gmail.com to discuss further. Now, back to the video. Now that we grasp the fundamental idea of what defines a financial institution, let's delve into the Financial Action Task Force's definition of same. According to page 129 of the FATF Recommendation Handbook, a financial institution refers to any natural or legal entity that conducts one or more of the following activities as a business, either directly or on behalf of a customer. Number 1, acceptance of deposits and other repayable funds from the public. Note 88 clarifies that this includes private banking services. Number 2, lending, which encompasses various activities such as consumer credit, mortgage credit, and factoring, with or without recourse, and finance of commercial transactions. Number 3, financial leasing, excluding leasing arrangements related to consumer products. Number 4, money or value transfer services, excluding entities that solely provide support systems for transmitting funds to financial institutions. Number 5, issuing and managing means of payment, such as credit and debit cards, checks, traveler's checks, money orders, banker's draft, and electronic money. Number 6, providing financial guarantees and commitments. Number 7, trading in various financial instruments, including money market instruments, foreign exchange derivatives, transferable securities, and commodity futures trading. Number 8, participating in securities issues and offering related services. Number 9, engaging in individual and collective portfolio management. Number 10, safekeeping and administration of cash or liquid securities on behalf of others, often referred to as custodian services. Number 11, otherwise investing, administering, or managing funds or money for others. Number 12, underwriting and placing life insurance and other investment-related insurance. Note 92 mentions that this applies to both insurance companies and intermediaries, such as agents and brokers. And finally, number 13, money and currency changing services. Recall what was mentioned earlier in the video's introduction. We discussed how various jurisdictions classify banks differently as financial institutions. Mauritius serves as a good example, emphasizing the importance of consulting the AML and CFT laws relevant to your region. Now, let's delve into Mauritius. The country indeed upholds the AML and CFT standards, guidelines, and recommendations set by the Financial Action Task Force. In 2002, Mauritius enacted the Financial Intelligence Anti-Money Laundering Act 2002, referred to as FIAMLA 2002 locally, with the aim of preventing and prosecuting money laundering activities. This legislation also enables the confiscation of assets, whether in cash or otherwise, linked to money laundering activities, along with addressing associated matters. Established under Section 9 of the FAMLA 2002, the Financial Intelligence Unit of Mauritius, or the FIU, serves as the national central agency tasked with receiving, analyzing, and sharing financial information concerning suspected proceeds of crime, alleged money laundering offenses, and financing related to terrorism with the relevant authorities. Consequently, financial institutions are legally obligated to report any suspicious transactions to the FIU. As outlined in Section 2 of the FAMLA 2002, a suspicious transaction is defined as one that A. raises reasonable suspicion of involvement in money laundering, proceeds of crime, terrorism financing, or proliferation financing or related activities, and B. occurs under unusual or unjustified complexity, C. lacks economic justification or lawful purpose, D. involves a person whose identity is not satisfactorily established, or E. arouses suspicion for any other reason. Now, this is where it gets interesting. Let's see who is responsible for reporting such suspicious transactions to the FIU. Section 14.1 states, quote, notwithstanding Section 300 of the Criminal Code and any other enactment, every reporting person or auditor shall, as soon as he becomes aware of a suspicious transaction, make a report to the FIU of such transaction not later than 5 working days after the suspicion arose, end quote. The key word here is reporting person. Let's now see what constitutes a reporting person. Section 2 of the FAMLA 2002 defines a reporting person as meaning, quote, a bank, financial institution, cash dealer, or member of a relevant profession or occupation. Section 2 further defines a bank as meaning, quote, A, has the same meaning as in the Banking Act, and B, includes a non-bank deposit-taking institution licensed under the Banking Act. Number 2, a licensee under the National Payment Systems Act, end quote. In turn, Section 2 defines a financial institution as meaning, quote, A, an institution or a person licensed, registered, or authorized under 1. the Captive Insurance Act, number 2. Section 14, 77, 77A, or 79A of the Financial Services Act, number 3. the Insurance Act, other than an insurance salesperson, number 4. Section 12 of the Private Pension Schemes Act, number 5. the Securities Act, other than an entity registered with that act as a reporting issuer and which does not conduct any financial activities. 6. the Trust Act as a qualified trustee. Number 7. the Variable Capital Companies Act 2022. Number 8. the Virtual Asset and Initial Token Offering Act Services 2021, or B. a credit union. Therefore, within the AML CFT framework in Mauritius, banks are not categorized as financial institutions, despite meeting the definition of financial institution according to the FATF definition discussed earlier. Consequently, the Central Bank of Mauritius has established its own AML and CFT guidelines for the commercial banks it oversees, notably through its guideline on anti-money laundering and combating the financing of terrorism and proliferation. However, these banks still have an obligation to report suspicious transactions to the FIU. On the other hand, non-banking financial service providers in Mauritius are licensed and regulated by the Financial Services Commission of Mauritius, and they must adhere to the AML CFT guidelines outlined in the Anti-Money Laundering and Combating the Financing of Terrorism Handbook. Similar to commercial banks, these licensees also have a reporting obligation regarding suspicious transactions to the FIU. The regulatory framework has been bifurcated between commercial banks and non-banking services providers. Thank you for sticking around till the end of this video. Your support means a lot to me, and I hope you found the information, insights, and key points valuable. If you liked what you saw, hitting the like button would be greatly appreciated, as it helps with the YouTube algorithm. I'll continue to share informative content regularly, so don't hesitate to return to the channel for more videos on offshore, global, and financial services. Take care, stay safe, and I'll catch you in the next one. Auf Wiedersehen and cheers!